Number one thing that we look for as investors as margins are falling, as input costs are going up, and in particular, labor costs have been quite sticky, and that's the largest expense line for most companies, in particular the asset-light technology companies. So human capital is going to be a big cost. So what we look for is pricing power. I know that's something that's been harped on a lot over the last 12 plus months by every investor and analyst that have come on your program, but it's important, right? Pricing power can get you through these periods where you have input cost inflation. We're still seeing input cost inflation. It's in part why we're seeing margins come down for the 7th straight quarter. So we want companies that have wide economic moats, that are dominant in their specific categories, sectors, industries, and that do have that pricing power, the ability to kind of have that defensible position within the market. So I think as long as companies have that type of dominance, then you can get through these periods of higher input cost inflation. And we're seeing that at some level with the earnings that are coming in. Look at the technology companies that spent the last 12 months reducing headcount, reducing R&D, and just trying to trim fat. We are seeing better margins and better profitability result. And in some ways, they're beating analyst expectations, as we noted.
For so long, Jason, we've been kind of looking at performance through the lens of the macroeconomy, of what's happening to interest rates, whether there's a recession coming ahead. Do you think we're moving past that conversation now? Are we moving into a new era where that's just old news? And if so, what's the new narrative?
Yeah, so I think we are moving past that conversation because those who were calling for recession, and that was really the consensus in the second half of 2022, I think it's in part why the stock market bottomed last October. But we've seen that consensus expectation, whether you look at Wall Street economists or we look at investment strategists or just the investment community writ large, the idea that we're going to get a U.S. recession, I think most have kind of capitulated off of that. We've got exhausted waiting for the recession because, here we are 12 months after a yield curve inversion and it still hasn't arrived yet. And really, we're seeing, a robust economy. We got a 2.4% Q2 GDP print just today. The consumer's holding up. The jobs market is strong. We've added 1.7 million jobs year to date here so far in the U.S. So I understand the exhaustion around the recession narrative, but nevertheless, if you look at history, that's pretty common where we have recession as consensus. It doesn't unfold. Folks get kind of tired of waiting for it. And then just as we get tired of waiting for it and we look the other direction, we see a slowdown in the economy. We think this time will probably be no different, unfortunately. And our view is that a recession is likely still, if you look at over, let's call it the next 6 months or so.